That's your call?
I would say that's our base case, yes.
Starts next week.
I mean, I can't give you the hour of the
You
day.
said it might start next week.
But that's 5 days.
If you want to put yourself out there, by all means.
Yeah, but I think it starts within the next week, yes.
Okay. Stay with us. We'll expand the conversation. Let's bring in CNBC contributor Courtney Garcia of Payne Capital Management and Obermeyer Wealth Partners, Allie Flynn Phillips. It's great to have you both with us. Court, you sat here. You heard everything that we talked about. He went right down the checklist. Valuation, that's not a problem. Too much speculation, not really. Too much concentration's justified. Is the consumer bad? No. Consumers find seasonals. He's a contrarian. He said we could have this rally starting next week. What do you say?
Yeah, I do think that we are well positioned here for a good second half of the year. I mean, we just continue to get good data on the economy. There is some questions with the labor market, and so I think we want to continue to see how that comes out. But I think at this point, we're just not seeing the consumer fall off a cliff, to your point. Like, yes, credit card balances are going up, but we're nowhere near like the peak levels we were before COVID. So I really don't see this issue where we're going to go into some sort of a recession. And I also think if the Fed starts to lower interest rates, which is widely expected they will in September, those money market funds are going to be paying less and less. So that's one rate cut, but especially if we see multiple rate cuts, you're going to start to see some of that money coming back out and making its way back into the markets, which has not been happening over the last year, but at some point you're going to start to see that as well. And that's something that I don't think is priced in at this point in time.
Allie, what's your take here?
I don't know. I think the best way to describe this environment is like a tug of war between the economic drag of tariffs and then the U.S. corporate earnings strength. Yeah, the latter's winning so far, but getting granular is key to see in terms of which companies and consumers are going to eat these tariff costs. If you look at the earnings season so far, is largely fueled by artificial intelligence and financials. Around 80% of the companies exceeded expectations, which led to, in terms of revenue margin growth, surprisingly resilient and increase in terms of estimates for 25-26. But there's this huge bifurcation. As we talked about earlier, the Magnificent Seven stocks, average earnings about 26% versus the rest of the market 5%. We should see that convergence, but this sort of imbalance of power to us is in terms of disturbing long term. As much as I love the bullish sentiment today, we wouldn't be surprised if you see a little bit of this tension between in terms of the earnings and this sort of tariff framework. I mean, tariffs likely are set up about 19%, which we do think is an economic drag. But for us, we wouldn't be surprised if we see a pullback. But in that case, we think you have to be poised to take advantage of some good opportunities.
By the dip, Tom, is like even those who suggest you could be in for a period of bumpiness, maybe some turbulence, maybe some kind of a pullback, the suggestions have been that they would be bought pretty quickly.
Yeah, I mean, really since 2020, the dips have been shallow unless we have structural problems. I would say it's a good sign that investors are cautious, which is what we're finding. And as Laura was mentioning, there's tariff concerns. People just want to get through and see what tariff impacts there are. But we also know that consumer expectations around inflation are cooling. I mean, it's prevalent in the UMich surveys, the Consumer Conference Board, and also the New York Fed. So I think the Fed correctly is being patient, but that's a catalyst because if we think there's cuts in the fall, that's good for stocks.
I did also see today, it was Bank of America's Flow Show, which showed a fair amount of money moving to cash. That maybe there's some anticipation of a pullback. Maybe not a full-blown correction, but a pullback that wouldn't feel that great.
Yeah, and I think pullbacks are normal, obviously, especially after this kind of run-up that we've had since April. So I do hope that this turnaround happens next week, which you're calling for. I would love that. But I do think if there is a pullback, it absolutely is going to be a buying opportunity. But the question is where you're buying into. Because, yeah, there's this huge concentration we talk about right now. Those 10 stocks are about 40% of the markets right now. And that's where something... I don't know if that trade is over. I'm not saying get out of those stocks. But a lot of clients have looked at their portfolios, and they have no idea how concentrated they are. They have all these different mutual funds, a bunch of stocks they own. If you look at them in aggregate, you own so much exposure to these 10 companies. And that's what I want to caution investors. Say, own those, but make sure you're not owning so much of it that if those things start to pull back, or you do start to see international continue to outperform, if there's this rotation to small caps, whatever it is, you want to make sure that you're diversifying your money, especially on any pullbacks that we see.
Allie, where do you come down on that? There's a reason why they're concentrated. The earnings season pretty much just told you why the money continues to go there. Do I just want to stay there and play whatever offense I think I can get still? And look, the defense that these stocks have provided investors is a draw as well.
Well, the nice thing about it is there's other opportunities out there. And we've had a lot of talk about NVIDIA, which we like as a great company, but why don't we pair it with something like Taiwan Semiconductor? Complex high performance computing chips is a growing industry where TSM has about a 9% market share and growing. It just beat expectations across the board, but it's trading at 22 times earnings, not 30 times earnings. Eventually, it actually should really trade at a premium to the S&P, given its moat. But right now, to us, something like that looks like a deal. Moving into a different sector, animal health, Zoetis, a resilient and growing industry. Animal health is probably GDP plus. As we know, many people will forego their own health expenses for pet expenses. Long term, we see this humanization of pets. And because everyone's been so focused on the Mag 7, you've seen in terms of real earnings compression in a company like this. To us, it's a great entry point. And then also remember is we can look up, we can look overseas. Something like in terms of some of the data centers to us would be attractive as well.
Tom, what about a big, beautiful broadening this market? Does that come?
I think we're primed for that because the equal weighted S&P PE is 16.9 right now. It was almost 18 on the eve of COVID. So the market has gotten cheaper after facing all these stress, even at an all-time high. So is the case for stocks having better earnings performance there? Yes, if the Fed starts cutting and we're onshoring and the ISM's been below 50 for almost 30 months now, we haven't really seen a peak of a cycle until ISM breaks above 50 for a sustained period. That's earnings broadening. Yeah, and that's great. That would be great for industrials, financials, and as I quietly say, small caps.
I knew you were going to go there, which I've had a pretty good week on rate cut expectations. Yes. But the reason why the equal weight has gotten cheaper, it's the cheapest since COVID, is because AI happened since COVID. So it's inflated the PEs of the top-heavy stocks and made all the others appear even cheaper because so much money has been going to the large cap tech names.
True.
So it's skewed a little bit simply because of the AI trade.
That's true. But then we should think of it in sort of second order effects. The first is that the earnings growth of the median stock has actually been very good. So, and we saw it in earnings season because 83% are beating, and now the stacked earnings 2Q versus 2Q is over 12%. That's not just the Mag 7. But the second is that we know that the AI is progressing at a pace that it's delivering real benefits to companies. So companies are now going to see the benefits. I can't point to what it'll be, but it's probably margins. And so that's a story that should be broadening earnings performance.